Momentum trading is a strategy that can be applied to both the traditional stock market and to cryptocurrencies. In both contexts, the term momentum basically means underlying trend strength. Momentum traders use market volatility to their advantage and mainly focus on the short-term price movements. They buy assets when they detect a beginning uptrend and sell coins or tokens at the highest point before the price begins to fall again. In other words, momentum traders follow the idea, buy high, sell even higher. The momentum trading strategy suggests that an asset's upward or downward trend continues once it has gained traction. This idea was established by the physicist Isaac Newton, who discovered that moving objects usually remain in motion unless disrupted by an external force. Hey everyone, it's Josh from Phemex team. Before we watch this video, remember to do the usual. Like it, comment if you have something to say, follow us on YouTube, and share the video with your friends. All right, let's get started. So what is momentum trading? There are two main subcategories of momentum trading, absolute and relative. In absolute momentum trading, the trader considers just one asset, such as Bitcoin, and analyzes its past price movements to predict future trends. In relative momentum trading, the trader compares different coins or tokens. For example, a trader may analyze Bitcoin's and Ethereum's price performances. In this case, whichever price history seems more promising is chosen over the other. So, how does momentum trading differ from long-term HODLing? One of the main differences between momentum trading and long-term investment is the time frame a trader HODLs a coin to make profit. Momentum traders buy and sell assets frequently. They are constantly on the lookout for new uptrends and lucrative buying opportunities. Therefore, momentum trading is a very active trading style for which traders use technical analysis techniques. On the other hand, long-term investors usually select coins with the potential to gain in value over time and often HODL it for an extensive period. This approach is more passive, as many buyers may invest without thinking much about their assets, hoping for an increase in value over time. Although momentum trading is usually associated with short-term strategies such as day trading or scalping, it may also apply to longer-term holders if the trend continues over a prolonged period. While market volatility is discomforting for many long-term investors, it is what momentum traders rely on to make a profit. Finally, one's unique trading style depends on several factors, such as personality type, risk tolerance, and personal preferences. So now let's take a look at how does momentum trading actually work. Momentum traders mainly rely on technical analysis, statistical probabilities of past price movements, and indications for future rises and falls in value. Therefore, momentum trading does not take into account information regarding the asset's use cases, politics, or the world economy, which could affect the price. Instead, the following factors generally play an essential role in momentum trading. The first is market volatility. As mentioned earlier, momentum trading relies on the size of price swings, especially on short-term rises and falls in price. It is, therefore, one of the most critical factors to consider when using this strategy. As momentum trading works best in volatile market environments, the highly volatile crypto market is more suitable for this strategy than the traditional stock market. Next is volume. This factor represents a specific coin's 24-hour market activity, or the number of coins that have been traded within 24 hours. A high volume indicates sufficient supply and demand for a substantial price movement. However, traders need to remember that the volume can be manipulated by whales selling or buying large amounts of assets at once. These traders own an enormous amount of cryptocurrency, giving them the power to drive the price up or down merely by entering or exiting the market. All right, the next is time frames. Momentum traders analyze price movements within different periods, such as daily, hourly, and even 15-minute charts. For example, if they detect the same uptrend in several of these charts, the momentum is considered significant. On the other hand, when the price increase is merely visible within one specific time frame, it may be part of an ongoing downtrend and therefore less significant. So now let's take a look at what kind of technical indicators momentum traders use. Many technical indicators can prove helpful in momentum trading. Among the most popular is the moving average. Essentially, a trader can detect a forming trend and a strong momentum by analyzing the moving average. The MACD indicator, moving average convergence divergence, is one of the most frequently used tools for detecting not only price movement, but also potential trend reversals. The next is support and resistance levels. So momentum traders can analyze support and resistance levels to detect potential trend pauses and reversals. The support level on a price chart lies where traders expect a halt or a reversal in a downtrend due to a concentration of demand. Conversely, resistance occurs when a concentration of supply causes an uptrend to pause temporarily. Once the price breaks through one of these barriers, the price movement becomes more volatile and gains traction. So let's look at some Bitcoin support resistance trend lines. We'll start with candlestick patterns. Momentum traders may also pay attention to candlestick patterns formed by price action on the charts. These formations can be bullish or bearish, which means they predict an uptrend or a downtrend in the price. Now we'll show some various formations, and if you're interested in any of them, you can read more about them on the complete guide to the most important candlestick patterns on the Phemex Academy. The first one is the piercing line. This piercing line candlestick pattern indicates an upward trend. The next is the hanging man. This hanging man candlestick pattern indicates a bear market. The next one is the bearish engulfing. This bearish engulfing candlestick pattern indicates a downtrend. All right. Another thing momentum traders look at is the relative strength index, which is widely known as the RSI. It's another valuable tool for predicting future price movements. When the RSI exceeds 70, an asset is considered overbought, which indicates that the asset's price is likely to decrease. Conversely, an RSI of below 30 indicates that an asset is oversold, so a price increase is expected. Although technical analysis can be helpful to predict market trends, its indicators should never be interpreted in isolation. For example, a trader should never focus on candlestick patterns alone, as they can be easily misinterpreted, especially by inexperienced traders. So, what are the pros and cons of momentum trading? One major pro is that momentum trading can be very profitable. Due to the crypto market's high volatility, the strategy works exceptionally well with digital assets. Momentum traders often gain considerably higher profits in a shorter amount of time than long-term traders. Additionally, employing technical analysis to predict price movements is an excellent way not only to make quick profits in a bull market, but also to predict forming downtrends. In such a case, it may be preferable to protect your asset from a substantial price decrease by buying a stablecoin instead. All right, the first con is that assets are more likely to lose value. So on the other hand, this potential for quick profit gains also means your assets are more likely to lose value just as fast. And depending on the frequency a momentum trader buys and sells assets, trading fees may also be a disadvantage of the strategies. These fees can add up quickly, especially when trading bots are used. All right, the second con is trend reversals may occur. So past success is no guarantee for future price movements. A trend could always reverse without indications. And studies supposedly proving the superiority of momentum trading over long-term investments may be unreliable. They do not apply to all trading scenarios because the strategy's success depends on the market environment. For example, while momentum trading works great in a bull market, it can be misleading and cause severe losses in bear and bull traps. In these scenarios, all technical indicators point a certain way while the price movement is in the opposite direction. So should you engage in momentum trading? Well, momentum trading is not for everyone. To be successful with this trading style, you need to have the technical knowledge and enough practice analyzing the market. Having the right personality type is also essential. If you feel easily stressed by the market's volatile movements and tend to make rash decisions and engage in FOMO, fear of missing out, the lower risk approach of long-term investing might be more suitable for you. In addition, you should be aware that any type of short-term trading requires constant research and engagement with the market. You need to be able to enter and exit at just the right time to maximize your profits and avoid unnecessary losses. If you cannot or are not willing to invest a good portion of your day into trading cryptocurrencies, then again, long-term investment would be the better option for you. Of course, you can always supplement your long-term Bitcoin HODLing investment by using the Earn Crypto service also provided by Phemex. All right, so to wrap up, momentum trading can help traders make an immense profit in a relatively short amount of time. However, it is essential to have a working knowledge of technical analysis and specific indicators of a forming upward or downward trend. The speed at which you can make a profit using the momentum trading strategy is the same speed at which your assets can decrease in value. Depending on your personality type and preferences, long-term investment may be more suitable for you than momentum trading. Lastly, traders need not limit themselves to a single strategy. Once you have sufficient knowledge about technical analysis, you can combine different methods and find your own unique trading style. Alright, that's it for this video. Thanks for watching, and I'll see you next time. If you don't have a Phemex account yet, just click on the link in the description or scan the QR code on the screen. Create a Phemex account and you will get a 7-day free premium membership trial and other trading bonuses. To learn more about Phemex and cryptocurrencies, watch out the videos in the box on the left. And if you're new to the crypto world, have a look at the videos on the right for some of Phemex's user tutorials. Thanks for watching this video. Bye.